if they don't go through the steps that are illustrated and respond to one of those emails, I'm not putting a lot of time into them, right? If I send you a response today, book a call, and you don't do it, well, I'm not going to reach out to you. Then there's another email, another email. So if they don't respond to one of them, they're lower value than someone that instantaneously books. So as it goes through that process, that's where you want to spend your time, on the people that are engaging, not on the potential people that are engaging. But obviously it's a delicate balance, right? When you're building a business, you engage with everybody. But when you're offering something to somebody, you want to start with the most engaged audience.
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else with your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grinzik, and with me, as always, is John Cohen. How we doing, bud?
We were hanging in there. Not much, really. Just trying to figure it out.
Just another day in the life, right?
There you go.
Yeah. What are you guys looking at nowadays? Anything new? I know we touched on this a little bit, a couple episodes ago, but just curious where your mind's at today, because I know some days it's one way and some days it's another. And you said you're back in the office with Don, so I'm sure that's facilitated some good conversations.
Yeah, I'm trying to be different. I a couple of months ago started diving into New York, back into New York, from going since 2012, right? But we've been playing around with some multifamily properties there. We're still, our bread and butter is still, the value add, heavy lifting multifamily stuff. The two things we're thinking about are, back to those tertiary markets, like the Mississippis and the Alabamas, where we were very successful. Mm-hmm. The other side of me says, bigger metros, stay with what we were doing, but the competition is a lot more and greater than it ever has been. And then the other part of me wants to be different, right? We had a great podcast that's coming out shortly, talking about retail and office and, trying to be a little different. And that's really where my head's at right now, is just what can I do, differently, even talking about some potential development sites, not necessarily multifamily, some retail development sites or, medical office development sites like dentists and stuff like that. Because a buddy of mine, Mike Anspach, has been, he developed a great site down in Charlotte. So, we've been trying to find some demographic signs similar to where that was built. And, we're just trying some different stuff, right? We want to be a one-stop shop for real estate, not just multifamily. That's our bread and butter. We'll never deviate from it. Mm-hmm. But, we're trying to see what gets the most traction. And that's really where our head's at. So we're trying some different things, seeing how we can, integrate that, benefit our investors and be different. And that's really been the focus over the last couple of months.
Is it because of a lack of good deal flow in the multifamily space, or is it other reasons?
I think it's a mixture of some. I don't think it's deal flow. We're getting a ton of deals. I'm just not buying into. I'm not buying into the pricing yet, right? Mm-hmm. When you talk about bases of 110 a door in 70s and 80s construction, we were buying those for 20, 15, 30, 50, even, low 60s. Now you're talking about literally almost, 60, 65, 100% more. Well, nothing's changed basis wise, right? Yeah, cost of construction, blah, 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 blah. But, we're hanging in there. We'll see. Mm-hmm. We'll see.
Yeah, no, it's an interesting topic. It's tough to really figure out, is it an overvaluation, or is it just times are changing and, things are just becoming more valuable in general, and, people's return expectations are lowering, or is it, is there going to be some sort of a mini bubble or something like that? So who the hell knows? It's interesting, but it's tough to see a deal you would have bought a few years ago for, like you said, 40 a door, trade for, 60, 80, 90, 100 and feel comfortable with it. So it's not the easiest thing to stomach sometimes. So
yeah,
I hear you 100%.
For sure. I am not, on the bubble wagon, right? I don't think the bubble's coming soon. I'm on the side of very, very positive demographics and support for the housing market for sure.
Mhm.
Things that what you see today looking back, it's like, well, yeah, we've been talking about this for 6 years. The millennials now are 34 years old and they're buying houses and having kids. And you couple that with a pandemic where everybody wants to move. And then the generation right behind the millennials, they're major populations, right? Millions and millions of people, the largest population since the baby boomers who did the exact same thing. So, history repeats itself. So do I think there's a crash coming? I've been saying it for 5 years. I thought there was, so I'm obviously completely wrong. So super bullish for sure. And it's just trying to take advantage of that, right? You're trying to not pretend you're smarter than everybody else. Just, where are the opportunities? And then that's what we're trying to hang our hat on. Because you're right. You bought something 2 years ago for 50 a door. Now it's on for 100. That's difficult.
Yep, 100%. So we could talk about this forever, and maybe we'll touch on it more, but definitely want to bring our guest in and, introduce him and understand him and then bring him into the conversation. So with that being said, Abel, thank you so much for joining us.
Hey, thank you, Chris. Thanks for having me. John, this is awesome hearing you, brother. Your experience and just kind of the mindset of it. So thanks for inviting me to hang out for a cup of coffee. I appreciate it.
Absolutely. So kick us off. Tell everybody a little bit about, your background, your journey, and all that good stuff.
Yeah. So I'm a Texan, a native Texan. I grew up in Corpus Christi near the beach. Back half of my life, I've been in the Alamo City, San Antonio, Texas. And that's pretty much, me so far. Married, kids. I got a 3-year-old, I got a 1-year-old, and I'm like 41 today. Been married with my wife for 10 plus years. We waited a little while, and now we've got our two bundles of joy and our bundles of all of our sleep is dwindling away. So now, as they are trying to go through this, we are trying to learn through them as new parents. Mm-hmm. But man, I've been a tech guy for a lot of years. So IT, tech, hosting, and then basically all the way through my tech career, I started investing in real estate since 2008. We did 10 years of single family houses and finally saw a light that was multifamily or commercial real estate, essentially syndication. So we started doing that since 2018, and we're general partners and principals in about 650 doors. We're essentially co-sponsored on a number of deals, a number of opportunities, and we started our first fund, fund number 1. We're about to go to fund number 2, and we have a new construction, new development. We haven't broken ground yet, but that's in the works by the end of this year. So it's just excited about all the way around and the future of it. And our goal is really to help as many new investors, new folks learn about what it is we're doing, because it's a new way to invest. This is for me, I didn't know that we could all partner together and go take a deal down that provides scalability, reliability, just better way to invest than what I had done in the past as me and my wife buying one single family house at a time. So it's I still blows my mind that how many people don't know this is an option to invest. In our circles, everybody knows about it. We all know kind of each other, and but outside of our world, it's just a new thing. So, anyways, that's a little bit about me, and thanks for having me on.
100%. Yeah, it's funny you bring that up. With I'm sure we could talk about the whole thing, but I want to talk about other things as well. Sometimes you get lost in the real estate community of Bigger Pockets, LinkedIn, social media, podcasts. And you're like, everybody knows about it and everybody's doing all this stuff. And then like even this weekend, I was just at my sister's engagement party, and I was like trying to explain what it is I do to people. Yeah. And it's sometimes very tough to explain it very simply and communicate it in a way that people really grasp very quickly. So it's nice to have those reminders of when you talk with people that aren't as exposed to it. They're like, oh, what are you doing? Like, you buy apartments or houses, or like you flip them? And I'm like, kind of all of that, in a nutshell. You're not wrong. You've got the general idea, but not quite. So it is sometimes important to remember, not get caught up in your own bubble and, step outside, because there are a lot of people that still don't really know about it or understand it.
I can truly, through this pandemic, I thought I did a decent enough job telling people, right? And then I've admitted I've sucked at it for quite some time too. But through this pandemic, I'm getting the questions of, oh, how's the real estate market like? Are you like, they believe I'm just like an agent, right? Like I've had more of those questions from people that have known my deals and what I've done for 7 years. And now they're asking me like, are you selling anything? Like, I was like, what do you mean sell? I was like, well, or are you buying anything? Or they ask me questions that are so geared towards like, I'm like a facilitator of transactions, like a real estate agent. And there's nothing wrong with that. And I'm like, no, I just, now I don't even, I just roll over and I'm like, yeah, that's fine. That's
Real estate market's doing well. We're doing a lot of sales, You're like,
it's difficult.
I don't do that, but they're cranking away, right?
Yep. Yeah, no, it's difficult. I'd love to hear, and this is probably a good question for anybody we have now. When people ask, because you're right, you get so hell bent in these communities and it's like second nature to you. You go to a wedding, you go to a party and someone comes over and you're like, oh, what are you selling nowadays? And I'm like, we have a 92 unit. It's like, oh, okay. But how do you break it down to someone outside of the circle? Because you're right, there's so much opportunity that people don't know about. But tell us, a little bit of the secret sauce without giving it all away, so people don't want to take it.
Yeah, no, I'm pretty social guy. Social meaning I like shaking hands, meeting with people in big groups, and also through COVID, like LinkedIn, Instagram, videos, webinars. I've been pushing a bunch of content, so all the secret sauce is out there. But it's what I end up saying all the time is, oh, we invest in real estate, and what we do is we partner with a bunch of folks and all pull our money together. So we buy something bigger than we would have been able to buy on our own. And that's kind of how I end up saying it. And people are like, what, you buy apartment complexes? I'm like, yeah, bigger apartment buildings. And the word complex, I'm in Texas, right? I think we know apartment complexes, but when I talk to somebody in a different market, I have to be careful too. They say like an apartment building, like a building. And I go, yeah. Like an apartment building. So I guess you do have to be careful on that, but it's, we're buying apartment buildings. And I would buy single family houses on my own. But now we partner together, and there's a bunch of people that all put a little bit of capital in there, and we buy something bigger than we would have been able to buy. And then also I kind of describe it's kind of like when somebody says it's like you like flip houses, Chris, or I think I heard something along those. I just say, yeah, it's kind of like a flip. It's like a 5-year flip. There's more doors. We buy it and we try to buy it at a low price. We put some money in, rehab it, but it takes longer because it's 100 doors all at once. And it's like we're flipping the house, except we flip the apartment buildings in about a 5-year, because we typically do about 5 to 6 year holds. And so that's kind of two things that I end up saying over and over and over again.
Yeah. The one thing I've found to be a little bit helpful is I'll kind of explain it like a single family house and then just say like times 100. So I'll be like, imagine you bought a house that somebody was renting. You put 20% down on a $100,000 house, you put down 20 grand, you bought it, you rent it, they moved out, you fix it up and it's nicer. So you rent it for more. Now the house is worth more. But I said, imagine you didn't have 20 grand. So you go to a friend, you both put in 10. Well, now you both own something. I said, it's the same concept, but you do it times 100 and it just takes a little bit longer. And I don't know if that really works, but I see a little bit of light turn on sometimes. So I think that's a little bit helpful too.
The 10 and the 10 makes sense, because it's like, oh yeah, I didn't have 20 grand, but I had 10.
Yeah.
So one of my other friends came in that had 10.
Exactly. And so that's helped sometimes too. But I'm really curious because something that we've always talked about was going from the one-off syndication to the fund style. And you've obviously just done it. And I think a lot of people talk about that too, because it's very easy to see how to go, do the one-off deal. And, there's a pretty clear path to that, I'll say, to a certain degree within, the bubble. What was it like for you transitioning into a fund structure, and why did you also go that route?
Yeah. Well, for me, it was really opportunistically. So we have done one deal at a time, all syndication. For the most part, it was a 506B, and those are, people we had existing relationships, right? So one deal at a time. This opportunity that we were getting into was it's a fund of funds. So our fund wanted to invest our money into a much larger fund that was kind of like an institutional grade, deal with like Pinnacle and Graystar and RealPage and RealManage, and they
Mhm.
were going to create a REIT. So and I always wondered, I go, oh, that real estate investment trust, like stock, if you know, if you're not familiar with the REIT, right? But you go and buy it and you're like, okay, it's 10, 15, $20 or 500. I can buy and sell a piece of stock. It's cheap.
Mhm.
But those REITs are created from people that buy big, huge portfolios and then they sell them all as one package. Well, the fund was creating their own REIT. They're going to buy one deal at a time over the next 7 years, and that's the exit strategy. And it's a faith-based. They're trying to create the first faith-based REIT, and I'm big on faith and that part of it. So I was like, I'm behind it. They've got a nonprofit in it. They're going to go support other people through the mission, but their minimum was $1 million.
Mhm.
And I go, well, I don't have $1 million to invest as a passive investor, but we created a fund to raise the $1 million minimum. And our fund is essentially an LP in a bigger deal.
Mhm.
And it felt like somewhat of an easy button for me to not have to create the actual portfolio properties or take people's capital in without paying them, and all of the difficulties I think of a true diversification fund. If I'm buying 10 deals this year and saying, hey, this is fund one and diversified, they're doing all the hard work, and we put our investors in our syndication, and then we put it as an LP into theirs. And so that was kind of like fund one, fund manager. Let's
Mhm.
go through this process a little bit. It's almost like my first deal in syndication was, I was not the lead sponsor. I didn't take the finding. I was not the, running it. I was not the full on, person that was leading the charge. I was kind of just riding shotgun. And now I kind of feel the same way. Oh, we've got a fund. I'm not really riding shotgun. It's an entity of trust, and let's get after it. So that was a decision there.
Mhm. Awesome. I love that. And
Yeah.
how did those conversations go with, all these investors that you knew originally? Like, hey, we're gonna try
Yeah.
something new. Like, did people,
Hardest capital raise ever.
yeah, like, did they respond well? Did you have to like convince people? Did you just have to broaden your net of people you were talking to? Like, how did it
Yeah.
actually go, and what did you have to do to get it accomplished?
This is my hardest capital raise ever.
Mhm.
So that was remember, it was essentially, I'm learning this term, blind pool fund.
Mhm.
You're like, hey, convince. Well, I don't want to say convince. I didn't do a lot of convincing. It was more like, hey, trust me. If you give me your money, we're gonna go buy something good. I promise.
Mhm.
It was probably it was literally my hardest raise out
Right.
of all the other 7 deals leading up to it. And that was a difficult thing, still proving to be difficult. In fact, when we do fund two, I'm changing it up a little bit. But the first one was that here's an example of what we're gonna go buy. Here's what we're looking for. Here's the qualifications. And we try to be very descriptive, actual properties we're offering on,
Mhm.
1990 to 2010 properties, B plus characteristics. That fund is buying like 250 unit plus deals, bigger deals. Here's what they look like. Here's a character. Here's all the 9 markets that we're investing in. I mean, it's a big setup. Here's all the right people doing the deals. But the question at the end was, so is there a deal today? You're like, no, we're gonna go buy.
Mhm.
I think once it gets moving, if there's like 7 assets in it, much easier capital raise, because then it
Mhm.
could be, here's the assets they're already in under ownership. Here's what you're coming into. Or, hey, if there's a deal that's under contract today and it's closing tomorrow, I think that it will remove a lot of the gray areas. But essentially, right now, it's like blind pool fun. Hey, give me your money, trust me. So
Mhm.
that's the hardest part.
Mhm. Was there anything when you spoke with people about as you're raising capital that you felt really helped them bridge that gap in terms of, trust and unknowns? Like, was it, a deep dive on all the team players? Was it, like, I guess I don't want to put words in your mouth, but what was it that
Okay.
really you felt gave people the confidence to commit?
I really multiple things I would say. One is telling them to set their expectations correctly and
Mhm.
showing them some upside. Here's a pro forma. It means really nothing on one deal. A pro forma is a bunch of assumptions, right?
Mhm.
I don't have one deal, and we're gonna buy deals for the next 7 years. So there's a lot of assumptions, and a lot of things could change. If you set your expectations low, like a 12% return. If you're good with that 12% return, then I think you're going to like this fund, because here's, a middle of the way road, I guess middle of the road performance. If we do 15 or 16%, man, we're overperforming. And here's some crazy upside that we're projecting if everything goes right. If you set your expectations low and that's good for you, you're going to, I think that was a lot of the explanation. I was like, okay, cool. And investors, for the most part, I think that's, if I could project into their minds, it was like, hey, this is a good conservative opportunity. Obviously the diversification of multifamily, because we've done a lot of Texas deals. So I think we have a few people that were like buying Texas. What's next? And showing them the first opportunity that they could diversify outside of the single market that I brought them. And then I think the other part was, it's kind of exciting to be able to buy like multiple assets with a $50,000 minimum investment. It's still for them, still $50,000 minimum. I mean, when the heck else are you going to be able to invest in and be an owner in and buy like these amazing apartment complexes at a $50,000 lick and be able to get into 10 or 15 of these deals over the next years? That's why I was excited initially. I go, my money's going to be invested across all these great, beautiful assets that I don't think I would have really ever had the opportunity to buy on my own. That wasn't in a REIT, or that it wasn't a stock. That wasn't something along those lines.
So, secondary question for you. You said it was $1 million minimum. Did you just raise the million, or did you raise more than that?
We're still going. So we're still raising right now. I think we're going to close it the moment the first deal is in. So we're projecting, that the offers are out there, the fund is going. And I think as soon as the first one goes in, maybe we'll close it and maybe regroup a little bit on, do we wait till there's a few more assets? Do we get back in? Do we get back in immediately? So I think that's going to determine the future, but still raising right now.
Okay. And then selfishly looking, and I mean, I can imagine the answer if you're doing a second fund, but being the hardest capital raise and then raising money for somebody else's deal. So I would imagine if you raised $1 million and put it into your own deal, it would probably net more money into your pocket as the lead sponsor. But putting in someone else's deal, maybe not so much, but it's also taking work off your plate. But considering it was such a hard raise, do you look back on it and say, hey, the time and energy that I took wasn't really worth it? Or do you look at it and say like, hey, this is just another thing that I can do and add to my plate? And the first one was tough, but now I've gotten through it and I think it'll be better and more worth my time in the future.
Yeah, very much the latter. The part that I'm excited for is ultimately the track record that we're going to create. Hey, this is fund one. There's a lot of learning that went into the first one. If I wouldn't have ever done it, I don't think I would be moving on this fund two, right? So I think that was part of it. It feels like, my first multifamily acquisition as a co-sponsor, which is, man, I just got to get through it and just get it done, get it under the, into the portfolio and say, hey, I'm an owner and let's try it again and let's tweak it and learn. And every single cycle has helped me. And it's proven to be, it feels the same way on this first fund. It's like, hey man, it's another cycle and learn through it. Would have made more if it was my own deal. Absolutely. To answer the first question. But I kind of feel like, there's a model where I have to do less of the work, at least this fund to funds, right? Because it's not my own. And then another kind of avenue where my head goes to is, I can always have a Reg D 506C always on fund that I can advertise and still take down an individual deal and use the 506C fund to kind of do other things, right? We can invest passively into other deals. We can opportunistically come across a good one that we wouldn't have been able to get in as a GP, but vetting the team out, put some capital in there, or then, find a great deal for us and stick our fund money into our own deal. So that's kind of a little bit of avenue. It's kind of opening up more opportunities for us just to be opportunistic with. I like everything you said too, John, is, hearing you talk about being open to other types of asset classes whether it's new development, things like that, because there's some people that I've met in network this year and they're like other builders, and that's what they do. That's what they've been doing forever. And they construct and develop. And I'm like, well, I like those returns. I'm just not an expert in it. I'd love to be able to put some money into it and leverage their expertise, or be open to say yes to. We did a triple net lease net. We did a triple net deal. It was an industrial warehouse or portfolio, and it was a net sale leaseback. And I partnered with another team that had done 20 of these deals, 20 plus of these deals. And opportunistically, I was able to say yes. So having that flexibility would be really nice.
Mm-hmm. No, I think that's really interesting. And I think you bring up a really good point that I'd never considered. Having that 506c fund allows for a constant way to be able to market on all these different channels that you can't for a one-off syndication that is a 506b. And not even two, even if you were doing syndications that were a 506c, which would allow you to do that, well, you might only have that offering for 20 days, 30 days, 45 days, and then it's gone. And if you don't have another deal coming, well, it might hurt your influx of leads. As you guys have you guys been doing like paid advertising with the 506c offering, or not so much?
I haven't doing any paid advertisement, but I'm trying to be all over LinkedIn. I hired a number of things, right? A number of teams that kind of helping me scale. A podcast team to help me edit, show notes, publish, get that out there. We have an Instagram team that helps me create posts, get that information out, and push our events. I have an internal team that helps me with like LinkedIn, Facebook, and missing one other. Anyways, so we push our Facebook company, our LinkedIn, our company page, and all that stuff. And so we're like super social and pushing all that stuff out of there, and then making those little video clips and trying to get visibility and exposure where pre-COVID, I think there was a very select few amount of people that knew what I was doing, and those were people that I had relationships with. So now it feels like I'm just comfortable saying what it is we do. I was always so fearful. Every single 506B we did, I was so fearful to like put the wrong thing out on a video or social or do a podcast and answer the wrong. Like right now we're talking about a deal that we're raising for, and I can literally talk about it because it's a 506c, so I'm not worried about it. On the 506bs, I wouldn't have been able to. And I think we started the capital raise, and like you said, to keep it open. I think we started. Well, I know we started last year. It's been like a few months, so 4 or 5 months ish. And so it'll continue. And then once we decide to close it, start another one and be at least comfortable talking about returns with this fear of SEC off my, kind of worry-ish. Yeah. So that, all that, however you want to say it, it's where my head's at on that.
Have you been able to like successfully track and see where a lot of leads are coming from in terms of investors, or has that been something you're still working through?
I'm horrible at tracking lead sources. So definitely big, not a blind spot, because I know it's there, just an area of opportunity that we're not capitalizing on, which is where in the heck are all these leads coming from? So right now I have a Calendly link up, on our website. We have an invest page. We put the same tagline or the same website, which is 5tcre.com/invest, and people can contact me there. They put in their goals, what they want to do this year, what they're trying to accomplish. That sends them an email that goes out, hey, set up some time. So I can see them when they book my time on my calendar, and those are my new investor calls or new partnership calls or new whatever calls, but I have no idea how to tell if it's coming from LinkedIn, Insta, Facebook, social. I should probably add a button. Now that as we're talking, how did you hear about us? Facebook, LinkedIn, that's simple enough. I should at least do that.
Yeah, well, that's what we would do, because our whole campaign was, when I was with Toro, we had an active campaign. When somebody put in a lead, there'd be like a drip email campaign. And then the goal was always to have them book a call. And there was always a, how did you hear about us? But you never really get great stuff, because it's, it was like people just write like internet or social media. And you're like, well, that's not really helpful or specific.
Yeah, where?
So it was like a little bit tough too. And I think one of the things that's interesting, because people would tell me when I would jump on calls, like, hey, I heard your podcast and I saw you on LinkedIn and then went to your website. And it's like, well, if it takes 3-4 different mediums, it's like, which one, what do you choose, right? Do you choose the first one? Do you choose the last one? Like, you know, there's always a weird mix too of like, okay, what is actually the thing that was the most helpful in that? So I'm always curious to,
You know what, it's a good point though, because I was in marketing prior to sales, and I was a business owner in my 20s. I don't know if you've heard of Cutco knives, but I sold Cutco knives in college, and then I opened up my own office, and the company is Cutco, but the parent company is Vector Marketing. And so they taught us how to market, how to essentially recruit for new sales reps to come in to our office. And then the direct sales reps would go sell to in-home presentations, right? So our marketing was for new recruits to come sell knives with us, right? And we're marketing 18, 24-year-old kids, right? But they taught us some really good fundamentals on marketing. One of the old school things back then that I still leverage today is how many impressions, or how many impression is a good word to say, especially today. How many times did your eyeballs see your ad before it took them to come take action? And back then it was 2000 and I guess 2002, 2003, 2004. The number was like 7. It took 7 times for somebody to see one of our ads. There was no Craigslist or internet. It was the paper, literal ad in paper, or flyers, or messages on a whiteboard we would put at school. Hey, come, $12 base pay per appointment, internship for Vector Marketing, right? And we would do that. But today I've heard that number is like 21 or 23 impressions. It's in the 20s now. We're inundated by so much marketing today, whether it's pay-per-click or SEO or on our Facebook feed or on Insta or all the things that come. It takes like 20 something impressions. So to answer who knows whether it was the most important one they saw on a Facebook or a paid ad or an email. The point is they saw you freaking 10, 12, 14, 15 times, 20 times. And then finally someone say, you know what, I got to reach out to this guy or gal or business. If there's entrepreneurs listening, whatever business you have, right? Whether it's real estate or whatever, it's a big funnel. And, if you get more exposure out there, especially today, it's what we all need to do and get some more visibility.
It's a really interesting thing. I'd never thought about it. And one of the ways my mind started to go was I thought you were talking about, like, if you ever look at metrics on social media, like the number of impressions, like somebody viewed your video X amount of times, or, so many people saw it. I wonder if there's a way to start tracking all your impressions across all the different internet platforms or different platforms. And I would imagine there's going to be some sort of correlation, right? If it's like, across 5 different channels and you got, 10,000 impressions or 5,000 or 500, right? If you could get that up, if there would be a direct correlation in the number of leads or clicks or whatever coming in. So
there absolutely is. It's so working after Cutco, I worked at a IT hosting company. And so I worked there from startup in 2006, 500-ish employees. And I left in 2016. I finally exited. We got from 600 to 6,000 employees. We grew that company from under 100 million to a $2 billion company. And in my arena, they were spending $1 million a month.
Wow.
On social, what do you call it? SEO, pay-per-click marketing, $1 million out there a month. So they were driving a ton of inbound leads through the years. And that's exactly what you're mentioning. They have this huge funnel and visually diagramming it from dollar out across all the different markets, and then views, impressions, clicks, click rate, conversion rate from clicks to the front of the page to the second or third, to like join now, to the chat bubble comes up, to a lead that you're actually talking to on the phone, to somebody you're going to go reach out to. And there's tools, except, most of our businesses, we're small businesses.
Right.
we don't have the budget to do $1 million a month on that kind
So
of
that's
stuff.
what
It's
I was
great,
just going to
you know?
say, that is great, right? I think that's a goal everybody can aspire to be, but I think
Mhm.
99% of us are probably never going to be big enough to have not only $1 million net spend a month, but to be able to track it in such detail. Because I mean, you've got to have,
Yeah.
So many systems, so many people working for you, so many processes in place, the technology, all that stuff. As you talked about that, or as you've been doing some of this stuff, is there anything that you've thought about setting up or have set up that has helped you at least start to track some of this stuff, or at least thought about ways to kind of at least, maybe get 20% of that or 50% of that, and, kind of help you understand a little bit better and make some choices?
At a high level, I measure new meetings a month, and a new meetings per week. How many new Calendly invites do I have for new prospective investors that are on my calendar? And so that's kind of what it is. It's, can I get at least 5 to 8 new meetings a month? New meetings a week. And then that totals, hey, can I get at least, 20 plus new meetings a month? And I'm like, I'm happy. I'm actually too busy, right? It's kind of at that point where sometimes my calendar is booked out for like 3 weeks. I'm like, that's bad customer service also.
Mm-hmm.
For some investor that's coming in, that's, looking at investing, hey, I'm not unavailable for 3 weeks. That's, where it's like, time to scale and trying to figure that out. But at least to measure it as a small business owner, that's what I'm trying to figure out. When do I go hire another person, another teammate, and, that kind of thing. But yeah, that's kind
Well,
of the high
I know
level measure.
Ryan Gibson, who we had on not too long ago, just made a similar transition where he doesn't do any of those calls now. He brought in a team to start doing those onboarding calls.
My
Because
partner the same. Yeah.
He's probably someone you would really like if you haven't already spoken to him.
Who's that again? Say that one more time.
Ryan Gibson from Spartan
Okay.
Investors.
No, I haven't met him. Thanks for the intro. Or the thought.
I'll connect you guys. But he just did that where he just offloaded it onto his team because he was like, I'm spending way too much time onboarding people. And, now he actually does, he'll like look for, I think he called them like meaningful investors or stuff like that, where he felt like it would take, a more personal touch or interaction or something like that. So I think it's just a natural progression, everybody's going to have to go through, unfortunately.
Yeah.
And, I think the investor that is looking for the direct contact with, the principal or the owner or whatever, they're just going to naturally, shift to another type of, group or company or something like that. So I'm sure it's tough, and it's something that probably feels like a little scary to give up, but I think it's just a natural progression. Because
another part of scaling up, right?
Yeah, exactly. 5-day calls a week just sounds ridiculous.
Yeah, one thing, as far as tracking goes, one thing I always spoke about early on, 2013, I would send out a monthly newsletter, right? And all, everything out there, ActiveCampaign, MailChimp, whatever it is, tells you who read it, who opened it, who forwarded it. I would just have a spreadsheet, and I would create, okay, email sent, 1/1/2020, right? And how many people reacted. Then I'd make Facebook posts, how many people saw it, how many people interacted. And I would just create that for everybody in my contact base. And then I saw the people that were most engaging and not. So when a deal was presented, I worked backwards. I'm starting with the person that responded to every single event. I'm talking to the person that viewed every single thing. Now I know things have changed and it's different, and some things aren't showing views, but that's the other way to track it organically. It's a pain in the fucking ass, right? But it's, you started doing that, and you saw the success. But you're right. Now we're tracking different things, right? I want to talk to people. I want to interact with them. I want to see who follows. After our call, I send up a follow-up email. Who has questions, right? So they're more ready when we're ready to do something, as opposed to someone that just has a call and never responded. And another thing, and maybe it's ignorant or not, but we have an automated system. It sucks. I'll be the first to admit it. Chris knows that. It barely even works. Actually, I don't even know if it's working. But, one thing I do on another business that I have is I don't respond to someone until they, it's like a 7-sequence email chain. If they don't go through the steps that are illustrated and respond to one of those emails, I'm not putting a lot of time into them, right? If I send you a response today, book a call, and you don't do it, well, I'm not going to reach out to you. Then there's another email. So if they don't respond to one of them, they're lower value than someone that instantaneously books. So as it goes through that process, that's where you want to spend your time, on the people that are engaging, not on the potential people that are engaging. But obviously it's a delicate balance, right? When you're building a business, you engage with everybody. But when you're offering something to somebody,
Yeah,
you want to start with the most engaged audience.
I love it. I love it. Really good insight. Very helpful. Very helpful, brother.
So, Abel, what, I know you spoke about some stuff and, different things you're doing, but what is like the focus for you going forward? Because you do, a lot of different things. I mean, you have the loan brokerage, you have the meetups, you've I think a coaching platform too. You've got the syndications, the fund of funds. Like, one, how the hell do you manage all that? And then two, what are you looking at, going forward for the rest of the year and, in the next few years?
Yeah. Well, at the highest level, it's time management. So this is, if you can discipline yourself on your calendar, that's the only way that I think true freedom kind of is created. When do I want to go play golf like yesterday? And when do I want to spend time with my family? After 5 is typically my allotted time, 5 till 9 Monday through Friday. But from the time I clock in being a dad and they go to sleep Monday through Friday and my weekends, I still kind of do the Monday through Friday thing. But those allotted times, man, I'm like, no, this is, I'm not going to work there. I have like potential offers to be partners with somebody on a great deal, and the numbers look amazing. And I'm like, man, this sounds like a great opportunity. When are you going to meet on a weekly basis about this? When are you going to do asset management? When are you going to, and it's like, well, we're thinking Tuesday nights at 8:00. I go, man, I'm sorry, I'm out. I can't partner with you. You can't partner with us in the deal. I go, no, I can't, because I don't want to meet Tuesday nights at 8:00. That's the time that is sacred for me and my family, right? Mm-hmm. So if you can adjust this, I might be willing to consider, well, we've got full-time jobs. We're like, well, I'm sorry, I don't, and I'm not going to do it. So it's the discipline to, schedule your time and then keep that pretty sacred is very, very helpful with me making sure that me and my wife are together as an important, part of it, making sure that I spend time with my children, which is my highest, priority. It's like, it's my faith, it's my family, it's my friendships. And so it's trying to keep that, along with building a business, helping investors. I want to create wealth. I want to help my investors create wealth. I want to make sure our tenants are happy in each apartment building. I want to do all that. But if I'm not good, nothing else is going to be good. So I got to take care of myself first. And that's kind of the schedule, right? That discipline to do so is what creates freedom. And so I am doing a lot of stuff, but so you mentioned a bunch of things, right? All of those things, it's ultimately this top of funnel work, because when it boils down to, I think my 80-20, 80% of results come from 20% of the activities. What are those two things? It's find a good deal, find the next good deal, and find more investors. And if I can put those two things together, we can we can build a team that can help me with all the stuff that I'm not as great at. But that's kind of essentially is just find the next deal and find more investors, and the rest I can bolt on and work with partners that will kind of cover my blind spots, and that's kind of how I'm doing it. So
awesome. I love it. Yeah. There's a book, I think it's called Clockwork, where they talk about the Queen Bee rule and the QBR. And it's like, what's the one thing, if you only focused on that, like what's the one thing that would really, keep your business going and, improve it the most. So it's really interesting to hear you, basically do the same thing of like break it down as like, as long as I do this, everything else will sort itself out. Cause that is like, as long as the analogy is, as long as the queen bee, continues to stay safe and, produce more bees, the bees will figure out how to make honey and hive and grow and, all the other crap. But without the queen bee, they're going to die or whatever. I don't know exactly. So it's like it's just really interesting to hear you automatically fall into that. I don't know if that was conscious or not, or whether you had read that book, but it was just cool to hear you say that.
I haven't read the book.
It's a good one. You'll like it.
But I've always focused on the, like, always wanted to go to, and in my professional career, this is how I had a lot of success. I would find the top performer and I would kind of study, take them to lunch, ask them a bunch of questions, find out what they did. And the question that I would ask, and I think I try to ask this as many people as possible still kind of today. What's the one thing that drives the most success for you? Like if you had to do one thing and only one thing, what do you think is the most valuable thing you do every single day or once a week or whatever? And that is usually what I want to look. I want to look for them from their paradigm, right? But for me, it was kind of like, what is that? What the heck is that? Well, it's find another deal and find more investors. I can work with property management. I can outsource. I can bolt on teams. I can find other people that are great at what they do, construction management, project management, Gantt charts, spreadsheets, all that good stuff. Like, man, there's experts that I want to work with in that area. Mm-hmm. But if I can find more deals and find other investors, we're going to keep going. So that's kind of how I thought about it.
100%. I love it. I think that's an amazing place to wrap up. Really great topic to end on. So Abel, thank you so much for coming on. I know we've mentioned a few things here and there, but if you want to take the time just to let everybody know the best places to connect with you, learn more about you, follow you, listen to you, all that great stuff. Where can people do that?
Cool. I think the easiest way is our website because it's going to link to a bunch of stuff. It's the number 5 tcre.com. So 5tcre.com. If you go to /invest, you can register, fill out some goals. We'd love to set up some time with you. And man, if you follow me there, it's going to link to our LinkedIn and our Insta and our Facebook. And we do meetups and webinars and education, all the fun stuff. So try to give out as much, free education as possible. There's a book on the website, all stuff. So if anybody wants to learn more though, they can always set up time on my calendar and it's all through that website. So I appreciate you letting me, use your platform a little bit and talk with you guys and, just kind of spread the message. So thank you.
Yeah, for sure. Sincerely. Guys, definitely go check out the website. Also go check out their podcast too. I know it's a big hit.
Oh, so my podcast. Yeah, I forgot about that too.
Yeah, but that's on the website, so you can't miss it. So go check that out as well. But thank you everybody so much for listening to this episode of the podcast. If you're not already subscribed, it would mean the world to John and I if you do so. And if you are, please send it to someone that would get a tremendous amount of value from this episode. Abel, once again, thank you so much for coming on, man. This is awesome.
Yeah, I appreciate it. And to you all, just real quick before I go for the listeners, you have to know John and Chris. I mean, they absolutely put so much time, effort, and energy to create a podcast, to spread some information, to provide free education. It is now that I know what it takes, it is a grind. So go subscribe, leave a written review, and the written reviews help out a ton. So I would just encourage you all that are already connected to them. That they're givers. Just continue to support them in their journey as well. So thank you guys.
Awesome. We appreciate that.
Appreciate it.